Will the stock market crash by 50% by the end of 2022? Well, that's what the data is starting to say, because there's two key trends going on right now in both the stock market and the economy that are very concerning. Number one is that we have a grossly inflated and overvalued stock market. Number two is we are entering a recession where companies are going to lay off workers and their earnings are going to decline. And today I have a special guest on this channel, an expert on the stock market and the economy, who's going to give us his insights on how much stock prices could be going down and when the bottom is going to be. And our expert today is Adam Taggart, host of the Wealthion YouTube channel. How are you doing today, Adam?
I'm doing great, Nick. It's great to be back on your channel. I always have fun talking with you. And yeah, this is a really important topic.
Because right now there's a lot of confusion over the stock market. We have the bears who are saying there's going to be a crash. We have the bulls who are saying, well, no, we're just starting a bull market. What do you think is the truth? Where do you see the stock market going over the next 6 to 12 months?
To answer that question in full, let's go back for a moment to the level of overvaluations, because that's going to be one of the first dominoes that's going to start this cascade going. In terms of just how overvalued the markets are here, we got a number of charts, but let me just start with a shortcut one that most people know, which is the Buffett indicator, right? Which is named after Warren Buffett. Sort of one of his cheats in trying to determine whether the markets are overvalued or undervalued. And what he does is he takes the market cap of the S&P, divides it by the GDP. Right now, the Buffett indicator is at 182%, which is historically very elevated. In fact, to get down to its historic trend line, it would have to fall by 43%. So we'd either have to magically goose economic growth, and we're going to talk in just a moment about how economic growth is actually contracting, so that's not going to happen, or financial asset prices have to come down, which is the much more likely outcome here.
I just think it's very important that people understand this, because there's so much discussion about all the short-term movements, like what is the Fed going to do tomorrow? What was the jobs report like last month? But in reality, all of these short-term indicators pale in comparison to the large indicator that you just talked about, that the stock market is 45% overvalued, according to an indicator that Warren Buffett uses. But so let me ask you, Adam, what do you think the next shoe to drop is going to be on the stock market, on the economy? What are the trends that we're seeing right now that have you concerned over the next couple months?
Okay, great question. If you're watching the markets closely these days, it's really hard to not pay attention to what the Fed is doing. Right after the pandemic, for the next year or so, year and a half, the Fed essentially put about $4.5 trillion of thin air, fresh new money into the system. That's an unprecedented amount of money. On top of that, Congress put another $5+ trillion of fiscal stimulus into the system. So we just had this tremendous tsunami of capital sloshing around, and it has to go somewhere, and a lot of that went into financial assets. So what's important about understanding that is both of those spigots have been turned off. The Fed is actually now gone into reverse. It's actually raising interest rates from their rock bottom lows, and it has started a process called quantitative tightening, where all of that stimulus it was putting into the system, it's actually now starting to claw back here. So those two things by themselves mathematically should be bringing asset prices down, and asset prices down pretty substantially.
Basically, it sounds like the training wheels are now off on the economy and financial markets, and that how high stock valuations have gotten, how high home prices have become, was a product of the long-term Federal Reserve intervention in lowering interest rates with quantitative easing and the lower short-term interest rates, as well as what you said about the $5 trillion in deficit spending that the US government did. So now going forward, what's going to propel the economy into the future?
Rather than say training wheels, say like, imagine like a hot air balloon, right? And the balloonist, the Fed, has had the fire that puts hot air into the balloon just raging at maximum until recently, but now it's actually shut the flames off. So the balloon, what happens when you do that? Well, you would think the balloon would stop rising, and maybe it actually might start sinking. And that's actually exactly what we're seeing, right? So if you look at the US GDP, it has contracted in both the first and second quarters of this year. The economic balloon is shrinking. And it's not just happening in the US, it's happening in all the major world economies. The IMF, in fact, they just put out their latest growth forecasts for the world. They had clocked 2021 GDP at 6.3%. For 2022, they're projecting a total global growth of just 3.2%. So that's an almost 50% decrease from just last year. And they're projecting even lower in the twos for 2023.
So this is potentially a globally synchronized economic downturn and recession, a globally synchronized stock market crash and housing crash. We're going to talk more about this global aspect of this downturn, which you really need to be paying attention to, because there will be contagion, everyone. But before getting into that, I want to talk a little bit about the housing market, because you briefly addressed mortgage rates and the fact that mortgage rates have come off their lows of 2.8% about a year ago, and now they're around 5.2%. And basically, higher mortgage rates has helped bring the US housing market to a screeching halt. Home sales are now at their lowest levels in nearly a decade. Inventory is spiking across the US housing market. We now have basically half the cities in the US already seeing home price declines. Do you think this housing market downturn is an analog and a prediction for what's going to occur across the US economy over the next couple of years?
Yes, I absolutely think that. And in many ways, I think what's happening in the US economy is going to drive what's happening in the housing market. So I talked about the Fed hiking interest rates, right? So no surprise, mortgage rates are going up. The Fed is actually trying to engineer that, right? It's trying to increase a higher cost of capital. And as you know, Nick, it's just math. Mortgage rates go up, home prices have to come down. And we're going to get a lot more into this in the video we're going to do just on the housing market. That's going to come right after we record this video. So I won't give away all the secrets here yet. But one key thing for folks to understand about what's going on right now in the main economy is, okay, so why is the Fed hiking interest rates? It's because of inflation, right? We have historically now very high inflation, the highest inflation in over 40 years. Inflation hurts companies. It hurts them because it increases the cost of their inputs. So all those additional costs are compressing profit margins. And usually consumers are buying less because prices are getting so high, consumers are having to tighten their belts. That all reduces corporate profits. So as corporate profits get reduced, well, what do corporations have to do? Well, they have to start laying off people, right? And also stock prices go down because corporate earnings are what drive stock prices.
This argument you're putting forth, Adam, about higher interest rates and lower consumer demand and lower corporate earnings, which are going to reduce stock prices further, this all makes so much sense. Like you said, it's just in the numbers, it's just in the data, but there seems to be a disconnect out there when you read the financial news, when you see what a lot of people who are bullish in the stock market and housing market are saying. Why on one hand do we have, for instance, consumers in America so bearish? Consumer sentiment is at an all-time low right now. A record number of people say it's a bad time to buy a house. But then on the other side of the equation, we have a lot of people in real estate and finance who are pretending like there's nothing bad going on, who are pretending like we're not in a recession. Can you explain this disconnect to me between the consumer and the regular American, and let's just say kind of maybe the elites who work in finance and real estate?
Yeah, I think there are two reasons for it. And the punchline is, I think the consumer's right. But, there's that old quote by Upton Sinclair about, don't expect a man to understand something if his salary is dependent upon him not understanding it. So you have to, realize that the status quo, the whole system wants the status quo to continue. Everybody in Wall Street makes money with higher stock prices. Everybody in real estate makes more money with higher real estate prices, higher home prices, more transactions. And so they're oftentimes the last people to tell you when the market is turning because they're desperately trying to keep the party going. That's, one big important reason is the folks that have been benefiting so much from, the everything bubble over the past decade. They don't want it to end. Part of that is they don't want to admit it to themselves, but they definitely don't want to admit to it publicly.
Right.
The second is sort of an analog at the national level where, this is an election year. We've got the midterm elections coming up in just less than 3 months. And the current party that's in power doesn't have a lot of strengths to run on right now. And so I think they're doing as much damage control as possible just in terms of the messaging. I think that's why you have so many kind of almost Kafkaesque, like 1984 style discussions about even if whether we're in recession or not. Really, just a couple weeks ago, the technical definition of recession, there's a lot of ways to define it, but the technical definition of recession was 2 consecutive quarters of negative GDP growth. Well, we've just had that. But suddenly, all of the administration economists are telling us, that's not really how you define one. And the media has picked up on that as well. I think both are under a lot of pressure from the current party that's in power in politics to say, look, you got to spin this as much sunshine as you can up until November 3rd so that we can get as many votes as possible. So that sounds quite cynical, but I do think that that's a component of what's going on here.
That's a really interesting take. And one thing I would offer to people is this is actually not a new situation. If you go back to 2007, 2008, just when the last recession started, but it was kind of unclear in late 07, early 08, if we were going to have a big crash, there was a very similar debate going on. If we were really in a recession, how bad would it be? Ben Bernanke, the Fed chair at the time, was out there in late 07 saying there's no recession, there's no housing crash. And then a year later, it became so obvious that they couldn't ignore it. But going back to the global perspective for a second, I think it's very interesting. If you look, for instance, at the Bank of England, they just came out a month ago and said to the people of England, there will be a bad recession starting at the end of 2022. So it seems like in different countries across the world, there's a lot more candor about the true reality of this situation. I'm wondering, do you think it's better for these leaders to be honest about the fact that there's going to be a recession and potentially make people have worse sentiment and spend less? Or do you think it's better for the central bankers and the politicians in America to be doing what they're doing and kind of have a more optimistic outlook?
Oh God, I'm always on the side of more honesty. And I'll tell you, I've been in the business of interviewing people for a long time. And I've oftentimes interviewed people, people who are in high positions of power in government, corporate CEOs, et cetera, who you interview them on air and they tell you one story. And then as soon as the microphone's turned off, they say, okay, here's all the stuff I couldn't say, right? Wow. And what's tragic is a lot of people will use as a reason to refute concerns that you raise as, you know what, if this was really bad, we'd be hearing about it from our leaders. They're not saying anything about it. So I'm taking it that everything's okay. And I'm telling you that a lot of times the leaders are intentionally not sharing the information because they don't want to create panic, create a self-fulfilling prophecy. And I think that's what's going on with these other countries versus say like the US. The Fed is really the central bank that sets the tune that everybody else marches to. And so if the Fed came out and said, hey, everybody, we think recession's coming, we think you better tighten your pocketbooks, the entire world is going to go into, deliberate austerity and start tightening their belts. And that's going to create the recession, maybe even in the Fed's mind, make it even worse or make it arrive faster than they'd like it to.
So it's an interesting point. Honesty is the best policy, but the Fed is in just a tough situation overall. And we're not likely to get a straight answer from them, which means for the people watching this who are trying to decide when to buy a house, when to buy stocks, you got to do your own research and look at the fundamentals. Like we talk about the Buffett indicator in terms of stock market valuation. One of my favorite indicators in terms of housing market valuation is inflation adjusted home prices. And right now, home prices adjusted for inflation and income are at their highest levels of all time, even higher than the 06, 07 housing bubble, which is wild to think about, right? That's recognized as the peak of the biggest housing bubble of all time in America. And yet home prices are more expensive today. And even though that's the situation, the conventional narrative has found a way to spin it like we're not in a housing bubble and there's not going to be a housing crash, which of course is already happening. We're seeing home prices go down in a lot of different cities already and inventory skyrocket. But back to the macro economy for a second, because in the end, the housing market, the stock market, it is all going to go where the macro economy goes. Right now, Adam, are there certain indicators you're looking at in real time to tell you if there's softening in the economy or if the recession is getting worse? Maybe it's layoffs, maybe it's consumer spending. What are you looking at and what should our viewers out there be looking at to get a better understanding of where the economy is heading over the next 6 months?
I look at a lot of the consumer household stats. So we look at, obviously inflation and cost of living. Is that getting better? Is it getting worse for households? Right now, we're still in a place where cost of living is continuing to grow at an unacceptably high rate. So that pinches consumer household budgets. Real wages have not kept pace. As you mentioned earlier, Nick, they've gone down. I've lost count of how many consecutive months real wages have continued to decline, but it's like over 15 or 16 months at this point in time.
So hold on.
Here's one of the key indicators. Let me just mention this one last one. I'll let you go. During the pandemic, when people were getting those stimulus checks, we actually saw a drop in consumer credit. We saw that people were actually paying off their revolving credit instruments like their credit cards. Well, that has done a complete U-turn. And we're now back at record highs in terms of outstanding revolving consumer credit. So what we're seeing is that the consumer household is getting more and more desperate, that it's financing more and more of its monthly living costs on plastic right now. And as you and I know, that has an end date somewhere where the credit card companies cut you off.
So basically, it sounds like American consumers don't have enough money. We've had crazy inflation for 2 years. The wages haven't kept up, and now they're putting more and more money on their credit cards. And I think a lot of people can relate to that argument, right? It's very clear that American consumers don't have much money and that they're really being strapped. But I think someone who would be more bullish on the economy, the stock market, and housing market would say, okay, Adam, I see that, but I also look at a job market that's one of the strongest job markets of all time. When you look at the unemployment rate of 3.5%, it's near a record low. When you look at the number of job openings, we have over 10 million job openings. So even though consumers are getting pinched on spending, the job market is still strong. So isn't that going to mean that the economy is going to keep going and keep growing into the future?
So I'm so glad you asked that question. I have a weekly market recap with Lance Roberts, who's a very experienced financial advisor. And he summed up the markets really well recently. He said, you know what? He said, all of the technicals are bullish, but he said, all of the fundamentals are bearish. And basically what that means is it's if you look at the price action of the stock, it's exhibiting patterns that you tend to see in a bull market. But if you look at the fundamentals and try to find out, okay, so what's causing stocks to go up? There's absolutely nothing that you can find there that justifies what the stock market's doing.
Well, I mean, I might say, I know some people who are like this. They say, well, the unemployment rate is 3.5%. We added 530,000 jobs in July. So that means I should buy stocks because the economy is doing well. Like, what would you say to someone who has that argument?
Glad you called out that payrolls report, which was the last payroll report from the Bureau of Labor and Statistics. There's literally almost no other data point that agrees with that incredibly rosy payrolls report that was issued a few weeks ago. And there's many people out there, and I count myself one of them, who are kind of looking at that as window dressing that's being used to sell a sunnier story than actually is reality on the ground. And, you know, Nick, you and I have talked, and I've got a long list, I'll spare folks from going through it here, but about the fact that companies are not just tightening their belts by, issuing hiring freezes. We're actually seeing real layoffs at real scale starting already across a huge swath of many different sectors in the economy. So it's kind of one of these deals where like the guy on the TV is telling you that it's sunny outside, but you're looking out your window and you're seeing the thunder, lightning, and rain.
I just want to say I love that analogy. Again, it seems like there's that disconnect between what people are reporting in the financial institutions and the government and then what people are feeling on the ground. And let's just talk a bit more about those layoffs. What are some of the companies now over the last couple of months that have announced layoffs?
So here's a good example, right? Where we're being told that it's a super strong economy. There's nothing to worry about. Okay, here's just a quick Google search that I did yesterday, and this was probably maybe 4 minutes of searching across Google. Wayfair just announced that they're laying off 5% of their staff. Peloton's laying off over 4,000 workers. Shopify's laying off over 1,000. 7-Eleven is letting go almost 1,000 management positions. Tesla announced that they're laying off 10% of their employees. Ford is laying off over 8,000. Remax, a realty firm, laying off 17% of its force. Carvana is laying off 2,500 people. Netflix and PayPal have undisclosed layoffs. And just to note one company too, so Amazon, in Q2, Amazon laid off 100,000 workers. It's 100,000 workers at just a single company. Folks that are telling you that everything's great out there, you look at the real data, it's really not.
Now, I was shocked at how broad-based those layoffs are. It's big companies, it's small companies, it's tech, it's real estate, it's banking, it's happening across the economy. And I suspect it's going to take some time for those announced layoffs to filter their way into the jobs report, but they definitely will at some point. And I also think, and you could tell me if you agree, I think these layoffs are just beginning, because when I look at what the CEO of Peloton said, it was very striking to me. After they announced the layoffs, he said in a letter to his employees that they will be going back into the office in November. And he made sure to underline that if anyone had a problem with Peloton, going back into the office, if any employees didn't want to come, he said, well, sorry, see you later. We understand your decision, but you're not going to be working here anymore. And so I'm wondering, are some of these corporate CEOs going to use the move back into the office as almost a stealth layoff to get people to quit?
Oh, absolutely. And another major employer, Apple, is right in the middle of doing the same thing right now. It's been big in the news this week. So I think that's absolutely a tactic that they're using to do it, where they don't come out looking like the bad guy, like, well, we just did an across the board layoff. We gave you a choice and you chose not to come back into the office. Just like the housing market exhibits several stages before you just jump to price cuts, right? Where you see, listings increase, you see listings get pulled as people don't get, the prices they want. They'll do everything they can. They'll throw benefits out there, et cetera, do everything they can before they start bringing down prices. It's very similar in the job market. Companies are slow to hire and they're slow to fire. Employees cost a lot to find, to train, and to retain. And so companies don't want to willy-nilly fire them. And so usually you have hiring freezes first, and then you have bonus cuts or hours cuts or contractor cuts. And only then after that, as sort of a last resort, companies start laying people off. And that's why I'm so surprised that we're seeing this many layoffs across this much of the economy this soon, Nick, because I think that, we are still in the very early innings. I mean, I might even say the first inning, or maybe the top of the second at most, in terms of the type of economic slowdown that the data is suggesting is coming ahead. So if we're already seeing these kind of layoffs right now, I think very, very conservatively, we can assume that when the recession that it looks like we're heading into arrives in full force, we're going to see the same scale of layoffs that we saw in 2008 or back in 2001, which is hundreds of thousands of people losing their jobs month after month after month. It's millions of layoffs in totality. And, I just worry because so many households right now are kind of hanging on by their fingernails. And these are still kind of quote unquote good times in a good job market. It's going to be much more painful 6 to 9 months down the road. And I think that's why these conversations are so important, both just about, what's happening with the markets, but also what's happening with housing is we're hopefully giving people advance warning so that they can take preparations today to make themselves less vulnerable to the impact that may be coming down the road.
What makes me concerned about that projection you just had is that I'm thinking about what's the impact going to be on the housing market, because already home sales are now at their lowest level in 8 years. Already home prices are going down in half the country. So then if you introduce wide scale mass layoffs into the picture 6 to 9 months from now, that's going to mean the housing market crash is also just beginning and home prices are going to go down even further. Click the link in front of you on the screen to see the rest of this conversation about how these layoffs and how this economic recession is going to impact the housing market, particularly what are the cities that are going to crash most. We're already seeing prices go down in some areas of the country. There's other areas of the country I'm going to be talking about on Adam's channel. Click the link in front of you.